The two-year Treasury yield just hit a 52-week high. That happened on Friday in a matter of hours, not gradually over weeks, in a single trading session. And the reason was a jobs report almost nobody saw coming. May payroll growth came in at 172,000. Consensus was around half that number. In one morning, the entire interest rate story changed. Markets went from pricing in rate cuts to pricing in potential hikes, and a number sitting in a bond auction far from your daily life suddenly became very personal. Let me explain why. Most people hear the phrase Treasury yields and tune out immediately. It sounds like something only hedge fund managers need to care about. But Treasury yields are actually one of the most direct lines between government finance and your everyday money. Here's how it works in plain terms. When the U.S. government needs money, it borrows it. It issues bonds, called treasuries. Investors buy those bonds and receive interest payments in return. The yield is simply the return the investor earns on that loan. When yields rise, it means investors are demanding more return to lend money to the government. And here's where it gets personal. Banks look at Treasury yields before they set their rates. Mortgage rates follow the 10-year Treasury closely. Auto loan rates track short-term yields. Credit card rates often move with the Fed funds rate expectation. When yields rise across the board, borrowing gets more expensive for everyone, not just the government, you. Now hold that thought, because what happened on Friday was not a small move. After the May jobs report dropped, yields spiked sharply across the entire curve. The two-year Treasury yield jumped roughly 15 basis points in a single session. It closed at 4.153%. The 10-year yield rose to 4.53%. The 30-year crossed above 5%. That is a significant move happening all at once. Charles Schwab traders noted the bulk of the weekly move came in that single Friday session. The yield curve, the shape of rates from short to long maturities, saw noticeable flattening. That is a technical term with a very human meaning. It signals that short-term rate expectations are rising faster than long-term ones. In plain language, markets are now betting the Fed is not cutting anytime soon, and some traders are starting to price in a hike. By early Monday, CME FedWatch data showed a 72% chance of at least one rate hike this year. That number was close to zero just a few weeks ago. And Colin Martin at the Schwab Center for Financial Research put it clearly. He said the balance of risks now favors a hike over a cut, though he expects an extended pause before any move. But even an extended pause at these yield levels matters enormously to regular people. Let me show you with a real example. If you are shopping for a home right now, and the 10-year yield climbs from 4.4 to 4.8%, your mortgage rate could move from roughly 7 to 7.5%. On a $350,000 loan, that is roughly $120 more per month, every month, for 30 years. That is not an abstraction. That is real money leaving your household. If you are finding this useful, consider subscribing for more practical financial insights. And it is not just mortgages. Auto loan rates have been elevated for over a year now. Rising short-term yields make that worse. The average new car loan rate is already above 7% for many buyers. Credit card interest is already brutal. Average rates are above 20% nationally. They do not fall until the Fed cuts. And this week's data suggests the Fed is not cutting. So every dollar you carry in revolving credit card debt just got more expensive to hold. Now layer on something else the markets were watching this week. Nearly $10 billion in long futures contracts were liquidated since Friday. Open interest declined alongside the move. That means leveraged investors were unwinding positions, not rebuilding them. When large investors close bond positions quickly, it can accelerate yield moves higher. It is a feedback loop that tends to take most retail investors completely by surprise. Now here is what gets interesting about the bigger picture. This jobs report created a genuine dilemma for the Federal Reserve. Their job is to manage inflation while supporting employment. But right now, both things are happening at once. The labor market is strong, inflation is still sticky, oil prices are elevated because the Strait of Hormuz remains closed. Middle East tensions reignited over the weekend. Prediction markets now put the probability of the strait reopening by August 1st at just 26%, down from 60% just a week ago. That matters because oil prices feed directly into everything: transportation, food prices, manufacturing costs. And the Fed has to factor all of that in. The Fed cannot cut rates into rising energy inflation, and it cannot hike rates aggressively without hurting an already stretched consumer. That tension is exactly why markets sold off hard on Friday. The Nasdaq dropped over 4%. The S&P 500 fell more than 2.6%. The VIX, a measure of market fear, spiked 28% in a single day. So what does all of this mean practically? First, if you are carrying variable rate debt right now, this week was a signal to take it seriously. Variable rate loans reprice as yields move. The window to refinance into fixed rates may be narrowing. Second, if you are sitting on cash in a savings account earning almost nothing, this is a moment worth examining. Short-term Treasury yields and money market fund rates are genuinely zero risk if you are simply keeping money in cash. There is a practical reason $7.78 trillion is sitting in money market funds right now. Some of that capital is positioned intentionally. Third, if you are an investor with a long-term horizon, periods of yield panic have historically created opportunities. Investment-grade corporate bonds declined this week, but new issues were generally oversubscribed according to T. Rowe Price traders. That tells you institutional demand is still present even when markets get nervous. The fear is real. The opportunity inside the fear is also real. This week in the bond market was one of those sessions that rarely gets explained properly. Yields move. Headlines say stocks fell. Nobody connects it back to your monthly budget. But the connection is direct. Bond markets are not abstract. They are the foundation beneath every loan, every mortgage, every savings account, and every retirement fund in the world. When that foundation shifts quickly, it matters. And this week, it shifted fast. The people who understand that connection will navigate it better. The people who ignore it will simply wonder why everything feels more expensive. That is what the numbers are showing right now. What you do with that information is up to you.